caught in the middle. Bank CEOs between Democrats and Republicans, Exxon management between new activism and old finances, and investors between inflation and a Fed that will have none of it. This is Bloomberg Wall Street Week. I'm David Weston. This week, investor David Booth of Dimensional Fund Advisors on why we shouldn't be reading too much into any of it.
Trying to time short-term movements in the market is more akin to gambling.
Investment banker Blair Efron on how a red-hot M&A market is holding back to find out where the Biden administration is heading.
It's a function of understanding what the regime, what the regulatory environment will look like.
And in a week that saw yet another challenge to big tech, this time to Amazon, Bloomberg's Stephanie Flanders on what concentration could mean for the economy overall.
Their efforts to hold on to market share are actually certainly reducing innovation.
This week had it all, starting with Belarus forcing down a civilian airliner to arrest a dissident passenger, leading to a disruption of European airspace, and moving on to 2 days of bank CEO hearings on Capitol Hill, where executives were caught in a crossrough between Democrats who were sure the banks weren't doing enough to help minority businesses and workers.
You and your colleagues come in today to talk about how you stepped up and took care of customers during the pandemic, and it's a bunch of baloney.
And Republicans who warned about the dangers of banks making decisions based on social rather than economic concerns.
When you mix business and politics, you get politics.
And if that weren't enough, we had a brand new activist group take on what was once the most powerful company in the United States, ExxonMobil, and force it to put its representatives on the Exxon board. New directors who would remake Exxon into a more climate-conscious company.
They really have to take a leadership role in transforming the operations of the company.
And the markets? Well, the markets pretty much ignored the geopolitics, the bank drama, and the shareholder activism, as all the equity indexes climbed for the week, with the S&P 500 near a record high and the Russell 2000 climbing for an 8th month in a row, while the 10-year Treasury remained within its range, ending the week with a yield just under 1.6. And if we needed any proof that the markets weren't paying much attention to the banks up on Capitol Hill, just take a look at the KBW Bank Index, which climbed for the week and is just off its high for the year. To take us through what we witnessed on Capitol Hill, we welcome now Allison Williams, Senior Financial Services Analyst to Bloomberg Intelligence, and Darren Williams, CEO of Southern Bancorp. Welcome to both of you. Great to have you. Allison, first let's start with you. You've described it as sort of Main Street versus Wall Street up on Capitol Hill. Okay, there was a duel there. Did it change anything? Did it change the banks? Did it change the regulations? What does it change in the real world?
So, David, I'm lucky to have watched these hearings alongside my colleague and policy analyst, Nathan Dean, and we really thought there were 4 key takeaways. First is the Main Street versus Wall Street, as you referenced, and I think really focusing on the issues of the day on the retail side of the business, nothing really on the systemic risk, nothing on capital rules, and importantly, nothing about breaking up the big banks. So this is the first time in a while that we didn't hear that kind of talk. And so the takeaway there is that perhaps we are moving away from the focus on shifting capital rules and trying to get tougher capital rules for the banks. Secondly, overdraft fees. Obviously, this was a big focus of the meetings, especially with regard to Elizabeth Warren. And the takeaway there is really that we expect there could be something coming from the CFPB, especially with regard to these fees. And, part of that might be, it just might be a win, whereas different legislation might be harder to get through. Finally, the Wells Fargo, the asset cap, we have a call that we expect that to be lifted in early 2022. There was nothing to change that. And then lastly, I would just say that it was interesting to hear from the CEOs just in terms of what they see as the key risks. No surprises there really for out of the 6, naming cyber, public policy and taxes from Jamie Dimon. Again, that's pretty consistent. But inflation, and then also Solomon talking about the global growth of government debt, which I also think is a key concern.
So, Darren, I must say that I think that you were the front and center for an awful lot of this. That is the CDFIs, those community development financial institutions, as well as minority deposit institutions. A lot of talk about that. You're a CDFI. Give us a sense right now of the relationship between these very big banks and the CDFIs. We heard a lot of talk about how they're really helping you a lot. Are they?
I must say they are. You know, this is the attention that CDFIs and MDIs have received during this pandemic. It has been unprecedented, particularly for a rural CDFI like Southern. We don't have a lot of overlap with very large Wall Street banks in our markets, and so we really hadn't had their attention before. But we now have the attention of Wall Street banks, and they're looking for true partnerships. And I must applaud their efforts. For example, Bank of America. They've made a multi-million-dollar equity investment in Southern Bancorp. And equity is the true capital that allows us to leverage and grow. And I've had several conversations with Brian Moynihan, and he wants to extend that relationship well beyond just making an equity investment, but also developing true partnerships. So we are talking more and more with members of Bank of America and finding ways that we can share resources, share technologies, and really help to serve underserved markets and underserved communities. So I applaud the efforts of Wall Street, particularly Bank of America, which we have a strong relationship with right now.
So, Allison, we heard a lot of talk from the senators and then the congressman about how we need to make more loans to more challenged businesses, smaller businesses, minority businesses. We didn't hear much about the standards of those loans. And I wonder if there's something of a tension here between, on the one hand, after the great financial crisis, really tightening up those standards, making sure the loans were being made responsibly, and making sure we're servicing some of the people who need it the most. Can you do both of those at the same time?
Well, I think you can. I think you heard a lot about the programs and a lot about financial education, helping to educate people, helping to invest in the communities. And I think that's really where banks can do a good job. But to your point, you do have to be careful of the standards. You know, obviously a big problem with the last crisis is that there were a lot of loans made that should not have been made. But at this point in the cycle, if you look more broadly across the banks, the issue really is not their willingness to make loans. They're more than willing to make loans. They have a ton of capital, and they're looking to make every loan that they can. It's really the demand side of things, and I think you do have to be careful there because you don't want to manufacture demand or go after that too aggressively because you do want to keep the quality of that lending. But again, importantly, you saw that each of the CEOs, when questioned about this, talked about the programs that they do have in place to try to expand financial inclusion.
Darren, what about the demand side? I mean, you're down there in the Delta, in Arkansas and Mississippi. What are you seeing down there in terms of demand for the small businesses? Because I know you go out and you make customer calls.
Absolutely. We make customer calls, and we see a steady demand. In fact, year over year, our loan demand's grown about 5%. And so here's where the relationships with larger banks and CDFIs and MDIs really can be important because we have relationships. We're proximate with the small business. So last year, for example, we did 7,022 loans. 47.4% of those loans were for less than $10,000. And that's not a loan that a large bank is really positioned to make. And that's not a knock on them. They're just not positioned to make that. But that's the type of demand that the small businesses in our markets need. And they don't need a 23, 24, 25% interest rate credit card for that. They actually need a reasonable rate, and we're able to provide that to them and then do much larger loans. But we're seeing a strong steady demand. That's a 5% net growth absent of the PPP loans, which we did over 2,000, over 150 million so far in paycheck protection loans we've done so far.
So, Allison, take a broader view here right now. We also had on Friday the budget come out, the proposal from the White House, with a lot more spending anticipated. What does that mean for the big banks? Are we looking at a steeper yield curve? Are they going to make more money in this new world?
Well, a steeper yield curve is obviously positive for banks. And, there's been a lot of talk about banks being inflation hedges. And I think that's been supportive to the banks. But at the end of the day, for the banks, you really need short-term rates to come up. And that's not going to happen for a while. So the steeper yield curve does help, but it feeds in over time. But at the end of the day, as Brian Moynihan pointed out, it's all about the economy. And as Jamie Dimon pointed out, what are you spending the money on? Make sure that the money that you're spending is contributing to growth. And I think that's what's going to be important for the banks in the long run, to the extent that we can get better economic growth and eventually get those an economy where we can have those short-term rates rising.
Darren, what are you seeing at a grassroots level there in the Delta, down there in Arkansas, in terms of the economy and the spending from Washington? Is it really taking hold of some of your customers?
Well, what we see is that we see quite a bit of money in the markets, or quite a bit of money in our accounts. We're at all-time high in deposits. So I think the stimulus dollars, they're having an impact on people. But we see people really cautiously optimistic about trying to build back, to grow back from this pandemic. Things are slowly starting to open up. We are beginning to see much more business activity, and that's promising. Our job is not really to guess where the rates are going to be. Our job is really to try to manage the spread. And of course, we do need spending on things that will grow the economy. I must agree with that. We need, for example, in the Delta, we need spending on broadband to increase business access and business opportunities. We need spending on bridges and on roads. For example, right now, the I-40 bridge between Arkansas and Tennessee is closed down through August. That's a major thoroughfare for truck traffic. We need things. We need money to be spent by the government on things that will actually grow demand and boost business.
Allison, you referred earlier to the overdraft fee issue, the little contretemps, if we can call it that, between Senator Elizabeth Warren on the one hand and Jamie Dimon of J.P. Morgan on the other. It was pretty dramatic, actually. How much money does a J.P. Morgan actually make off of that? I mean, if I were Jamie Dimon, I came away from that, I'd almost say, forget it. Let's not charge it anymore. It's not worth it.
Sure, and I think the focus on, I would say, so this is sort of one part of the overall package, right? Because there are overdraft fees, but then there's the overall value of the account and overall what you pay for the account. And so in general, and I should note that over time, the rules have changed, and it is an opt-in product that went to that several years ago. And then you've had someone like Bank of America introduce a product, $5, you pay $5 a month and you won't get these fees. That's about 30% of their base now. And their overdraft fees, are in the range of 1.5 billion, but they're down from 5 billion over 6 to 7 years ago. So this is really only like 1 to 2% of their revenue. But I think, too, it's interesting from the broader perspective that there's actually a competitive war going on with regard to these fees. We've had these fintech companies like Chime and Varo coming in, not charging fees. And we've had some of the regional banks, such as Fifth Third, coming in and saying, we're not going to charge these fees. And Herman Chan, who's our regional bank analyst, has done some work on this with Julie Chariel, who's also the fintech lead, just in talking about the fact that the regionals are cutting these fees just to compete. So I would say the clear message on overdraft fees is both from a competitive purpose and from a regulatory purpose, as that this is a source of revenue that's going away for the banks. Again, it's 1 to 2% for the big banks, more like 3% at the regionals.
But is it fair to say, Allison, that's not the biggest problem we got in banking today?
It's not. And as I said, if you think about it, right, it's one fee on the on an overall account, and so sort of an interesting focus.
Okay, thank you so very much to Darren Williams of Southern Bancorp, and also to Allison Williams of Bloomberg Intelligence. Coming up, his investment firm has been around for 40 years, and its success is shown by the $650 billion people entrust to it. We talk with David Booth, chairman and co-founder of Dimensional Fund Advisors, about what we should and what we should not be focused on this week.
You can't control markets, but you can control the amount of risk you take, for example.
This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. Each week on this program, we take a look at the big events of the week that the smart investor wants to be paying attention to. But let's be honest, sometimes it is hard to separate out the signal from the noise. We are fortunate to have with us today a really smart investor. He is Mr. David Booth. He is the chairman and co-founder of Dimensional Fund Advisors. They have been in business for 40 years with an extraordinary track record over that period of time. Welcome to Wall Street Week. Good to have you, David.
Well,
so let's talk about that 40-year history. I mean, I'm not sure that every month or every quarter, maybe even every year you were up, but over the long term, you did very, very well. Give us some advice. In that 40 years, What did you pay attention to? What did you leave behind and not get distracted by?
Thanks for having me on the show. Yeah, if you look at over the last 40 years, what we've learned, I think kind of ties in with your first comment, trying to separate the signal from the noise. What the set of ideas around which we built the firm have shown that you can have a successful investment experience without having to forecast the market turns, without trying to outguess the market. So a lot of that is tuning out the noise, focusing on what really matters. You can't control markets, but you can control the amount of risk you take, for example. So that's largely what it's about, is coming up with a sensible long-term strategy and emphasizing long-term, because if you're going to invest in risky assets, you need to have a long-term investment strategy. And it's a strategy that you believe in enough that you can stick with it through the ups and downs of markets. Markets are going to go up and down. That's what they do. And so what investors need to do is figure out how to deal with that uncertainty and come up with a sensible solution for them that they can stick with.
So isn't that one of the real challenges for an investor, David? Because if you didn't have uncertainty, if you didn't have risk, you wouldn't have gain as a practical matter. The one comes with the other. The question is, how much risk, how much uncertainty? I mean, when does it leave off being an investment and turn into a gamble? Because let's be honest, some of what's going on in the market sometimes looks to me an awful lot like gambling.
Well, totally. I mean, basically trying to time short-term movements in the market is more akin to gambling than investing. And, we think if you're going to invest in the market, you have to have a long-term focus. This last year, for example, has been, or the year 2020, was a great example. Market is down 30% the first few months of the year, and a lot of people bailed out. But the market ended up 20% for the year. So if you didn't stay invested, if you tried to time that market and got out, you missed out on a big return.
One of the big uncertainties right now that people are talking about in the market, at least, is inflation. Whether it's, as they say, transitory, as the Fed seems to be indicating right now, or as some people like Larry Summers say, there is a danger really of it getting to be run away. When you plan for the worst and hope for the best, as an investor, how do you do that with respect to inflation? Do you change your investment at all in planning for the worst on runaway inflation?
Well, I think you want to be sensitive to the idea that inflation could take off. Of people talking about inflation, I don't see too many of them saying, I really am confident I know where inflation's going. There are a lot of opinions floating around, and that's really the point. I mean, it's you can't forecast these things, and even if you could forecast where inflation is, you don't know what the effect's going to be on the stock and bond markets.
And as you approached this 40 years ago again, what did you really look at? Because people call you sort of a factor investor, because you tend to go, as I understand it, more value and more small cap. Was that a conscious decision you made?
Yeah. What we found was investors back in 1981 when we started, particularly institutional investors, were underinvested in small cap and really in value strategies as well. And over the long haul, small cap and value has historically had higher returns than large cap and growth. And so we have had a bias towards small and value, which, to your earlier comments, doesn't mean you win every year with those things. Until recently, there had been kind of a horrible run on value versus growth. Over the last 50 years, these ideas that we focus on have caused, fees to come way down, risk controls to go way up. So people should have a much better investment experience than they had 50 years ago. I think that's pretty exciting. And I tell students coming out now, you can have a great career in finance, and at the end of it all, feel good about yourself, because you can help people. And going forward, I might add, if we're going to help people out, part of the answer has to be better and safer financial services.
What could we do to make them better and safer?
Well, I think a lot of it is help educating people. People, what you might call noise is like a siren and calling people in to do silly things. All this progress, these ideas can be used for better. They can also be used for worse. I mean, with lower fees, a lot of people are attracted to come into the market that never would have gotten into the market 20 years ago. And that's terrific. But unfortunately, a lot of them have come in with the wrong set of ideas about how to invest. They think investing is gambling, and which is the wrong way to approach the market.
David, you led me to it. That sounds like GameStop and Robinhood and some of the meme stocks. What do you make of that phenomenon?
Well, you know, investing in markets can have a very high tuition in terms of education. You know, first time fortunately, people starting to invest frequently have very little money to invest, which is probably, helpful. Over time, people learn. There is no magic. That's part of the noise. People think there's magic out there. Somehow they don't have it, but somebody else has it. And if I can only figure out what that magic is, then I would really be set. It doesn't exist.
Some powerful advice from, as I say, a very smart investor, David Booth of Dimensional Fund Advisors. Thank you so much for being with us. Coming up, we take a look at the week ahead on global Wall Street. This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. It is time now for a look at the week ahead on global Wall Street.
David, the upcoming G7 meeting is front and center next week. India, Australia, and South Korea have been invited to participate in the first in-person summit in nearly 2 years. Now we also get GDP report cards and policy decisions from India and Australia. The RBA is expected to set the stage for a less dovish pivot, while the RBI may roll out targeted support for businesses hurt by the state-level lockdown in India, which is making it hard to predict when energy demand in the country will bounce back. Now that factor, along with Iran's return, will be up for discussion in oil markets when OPEC Plus meet next week. Danny?
Thanks, Sophie. Inflation is going to be in focus for Europe over the next week. We have headline figures for their euro area coming out, where we're expecting prices to have accelerated for the month of May. And in Italy, we get a reopening, or at least more easing of restrictions, with indoor shopping and outdoor sporting venues opening. Romain?
Thanks, Danny. A light week ahead with U.S. financial markets closed Monday for the Memorial Day holiday. Economic data will still be front and center with market PMIs, ISM manufacturing reports, and that May employment update. Remember, we had that stunning slowdown in payroll growth in April, where every single economist surveyed by Bloomberg overestimated the pace of job creation. The latest Bloomberg survey as of Friday shows economists expect about 670,000 jobs to have been added in May. Earnings in the week include Zoom, Constellation Brands, Lululemon, Broadcom, and CrowdStrike, and the Atlantic hurricane season begins during the week. Forecasters expect as many as 20 named storms this year, down from last year's record-breaking 30. David?
Thanks to Sophie, Danny, and Romain. Coming up, big tech, big media, and now a marriage of the two. We talk about what the dramatic increase in concentration in American business means for the economy, with our contributor, Stephanie Flanders of Bloomberg.
We have this perception that they invest less and certainly hire fewer workers.
This is Wall Street Week on Bloomberg. Big media is getting only bigger, with Discovery and AT&T's Warner coming together last week in an unlikely combination of cooking shows and award-winning dramas.
We're not just better together, but that we're probably the best media company in the world.
I can't in good conscience not allow these assets to develop to their full potential.
This week, it was Amazon's turn. The tech giant is buying Hollywood's iconic MGM for $8.45 billion, bringing James Bond and Rocky to the everything store, adding even more heat to the race to amass and stream entertainment content triggered first by Netflix and then Disney.
I think there's only a handful of truly global greater than 100 million subscriber base type of services that can exist.
Amazon's latest expansion in media comes after its move into groceries and bricks and mortar with its $13.7 billion acquisition of Whole Foods back in 2017.
And Amazon, the merger is working out great for us. We're a much better company today than we were pre-Amazon.
By expanding its entertainment and retail offerings, Amazon is adding more bang for the buck to its $119 a year Prime membership. Not to be outdone, Walmart launched a competing subscription service called Walmart Plus for $98 a year, offering free shipping and delivery. But Walmart still trails Amazon's dominance in e-commerce.
It's something I think we're all enjoying, overnight deliveries at low prices, but how long can that keep going on?
To the 200 million Prime members around the world, Amazon is a one-stop shop, but regulators aren't convinced it's in the public interest. This week, the Washington, D.C. Attorney General brought an antitrust case against Amazon, alleging it is engaging in anti-competitive practices that have raised prices for consumers, while Amazon claims that it does what every retailer does to stay competitive.
The monopoly power, Amazon tells you what to set the price at and punishes you if you do not adhere to those rules.
The consolidation of corporate power has reached an almost unimaginable scale. Since 1990, the profits of the world's 50 largest companies has gone from $68 billion to $788 billion, now accounting for more than 1% of total global GDP. And at this point, just 4 companies, Amazon, Facebook, Microsoft, and Google, together make as much money in 1 week as the entire country of Zimbabwe does in an entire year. Stephanie Flanders is a senior executive editor for economics at Bloomberg, and on a recent episode of her very important podcast called Stephanomics, she addressed the question of increased concentration in industries around the world. We welcome her now back to Wall Street Week. Thank you for being with us, Stephanie. So I listened to this podcast. It was fascinating. First of all, you and your team, economics team at Bloomberg, actually took a look at, has it become more concentrated globally, our industries, and you had some pretty remarkable conclusions.
Yeah, we were actually just taking stock of the biggest 50 companies in the world. Who are the biggest 50 companies now? And how does that compare in terms of the sectors they're in, the sheer size of them to 1990? And it was very striking just on the numbers that how much bigger they are as a share of GDP. Certainly their market cap is worth nearly a third of global GDP, or the equivalent of, which is up from 5% in 1990. And their profits are also about 3 times higher relative to the global economy. So we can see there's sheer scale. But clearly, we've also seen a big change in the makeup of who are those big companies. And it is no surprise, it's tech firms, much more evident than they were before, 21 of the top 50. So this, there's lots of things to say about that research by the chief economist, Tom Orlick, and his colleague, Justin Jimenez. But that was the sheer scale of these companies and their dominance in their industries echoes what we've seen in studies of the US, for example, that found 3/4 of US industries had seen an increase in concentration in the past 20 years.
And the role of tech that you refer to, I find quite fascinating because it does raise questions about the consequences of the concentration. I mean, in an industrial society, it was almost inevitable that prices would go up and quality would go down as you became monopolists. It's not clear that's happening with tech. In fact, if anything, the prices may go down as you get bigger and bigger.
Yeah, and of course, we're seeing in the numbers we're looking at that we've got a sort of dual effect of the rise of the tech giants, but also just globalization, allowing companies, if you're very successful now, you get to be successful on a global scale in the way that you weren't able to 20 or 30 years ago. But you're right that there are structural features of these companies. We have this perception that they invest less and certainly hire fewer workers per sort of billion of market cap than the big companies of previous eras. And that's borne out by this. If you just take IBM in 1990 was the world's largest company. It devoted at that point 9% of its revenue to CapEx, to investment spending every year. Now, if you take that, if you've come forward to today, Apple has that crown now. It's the biggest company of the world, and it's investing in CapEx a third of that amount, about 3%. So you can see they're investing less, and they certainly have fewer workers for their scale than the companies in the past, which affects their contribution to society.
And what do we know, if anything, because I know it's fiendishly complicated, but what do we know about what this does, for example, for productivity in the economy? Does it enhance productivity, not affect it at all? What do we know?
There's so much fascinating discussion around this, because we know that certainly we can look at the past and the way that telecoms developed in the US, that for a certain period, you can have a big rise of a company like this, or a big new tech company can be a driver of enormous innovation. And I think, Amazon would make that claim, Google would make that claim, and I think you can see innovation associated with their rise. But we tend to see historically, and this is something that Tim Wu and other people have written about, we tend to see that flattens out over time. Once they get their power, they're more focused on holding on to that market share, and their efforts to hold on to market share are actually certainly reducing innovation, and potentially not contributing to productivity growth in the economy either. So that's quite an important downside if it's true.
It's fascinating. I do recommend the Stephanomics podcast. You should all go listen to it. Many thanks to Stephanie Flanders. She is the Senior Executive Editor for Economics at Bloomberg. Coming up, talking of concentration, what does the Biden administration mean for the mergers and acquisition business? We talk with co-founder of Centerview Partners, Blair Efron.
Clearly, there is going to be a different regulatory environment now than there was during the 4 years of the Trump administration.
This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. As we've seen the last 2 weeks in the media world, mergers and acquisitions continue apace, despite what famed investor Carl Icahn thinks about some of the prices.
On a value basis, a lot of these companies are ridiculously priced, just ridiculously priced. And so eventually, you just can't have this without excess inflation.
Blair Efron, co-founder of Centerview Partners, is in the middle of many of the most important deals getting done. And he does admit that there are concerns out there about the market getting overheated. But he also has his eye on the yet-to-be-determined Biden administration approach to merger review.
Someone like me, frankly, we're always trying to figure out, look around corners and say, what are some of the clouds on the horizon? You just talked about inflation. We only have really a month worth of data. The economy of the world's opening up. You should assume there's obviously a mismatch in terms of materials allocation, in terms of jobs, but that's a data point. The markets generally, we obviously are being priced at a premium. P multiples on next 12 months earnings, 3 points above the 5-year average. You have pockets of the market where they're particularly heady, whether it's crypto, whether it's SPACs, whether it's just retail investment volumes. So you ask yourself, what were the antecedents back in 1999, 2000? Obviously, federal balance sheet is on people's minds, and then just the geopolitical situation. So I say that a ton of tailwind, but clearly a watch out.
So let's talk about mergers and acquisitions, Blair, a little bit. It seems to be red hot. And I will say right now, I'd love to talk to you about media. I'm not going to, because I know you're involved in the media deals that are being covered in the press all the time. So let's talk about mergers and acquisitions more broadly. Is it as red hot as we hear?
David, it's active, but it's been active for a decade. Okay, so I wouldn't really call it red hot. I would call it more of a normalized environment. We're doing $4 trillion a year of M&A generally. Half of that's in the U.S. That's what we ended up doing, believe it or not, in 2020, despite no M&A activity in the first quarter, middle of the first quarter, middle of the second quarter. And I assume the 21 timeframe, it'll be the same. I think what is interesting is the kind of transactions that are absolutely happening. I think you're obviously seeing continued consolidation deals, if you will, Kansas City Southern, Hartford Insurance. But actually, more of the market than not is what I would call scope deals today. And that's companies trying to find new markets, new geographies, and new capabilities. And that is a very different kind of M&A than the M&A we were all used to. And I think with that kind of tailwind, my expectation is it will remain a solid M&A environment for a time to come, irrespective, actually, of the underlying economic environment.
To generalize about what you just said, Blair, and correct me if I'm wrong, is that more sort of bolt-ons? That is to say, we're expanding into a new market geographically or something, but it's adjacent to what we're doing rather than something fundamentally different. Does that tend to mean somewhat smaller deals?
Well put. What you're seeing is a very robust market on a lower price point. The transformational deals, those deals, call it 10 billion or more, are absolutely slower than times past, and that's in fact, I think, a function of, one, valuations. They remain high. Right now, 14 times EBITDA is the average M&A multiple, and compare that to 2016, that was 11.5 times EBITDA. Combine that with an uncertain regulatory environment, and it would make sense that the mid-sized M&A market would be, which it is, outpacing the transformational market at this point.
So, Blair, you were very careful there in saying it's an uncertain regulatory environment. Is it uncertain or is it resistant?
So, first of all, the beginning of every administration, if you look back, Republican or Democrat, the first 6 months for M&A, big deals generally happen at a slower pace. It's a function of understanding what the regime, what the regulatory environment will look like, and then operating and acting against that.
That was Blair Efron, co-founder of Centerview Partners. Coming up, we wrap up the week with our special contributor, Larry Summers of Harvard. This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston, and we're going to wrap up the week as we always do with our special contributor, Larry Summers of Harvard. So, Larry, great to see you again, looking fit and well up there in Massachusetts. Let's start with the big event on Friday, which was the president's announcement of his budget. $6 trillion, $1.3 trillion in deficit in each of the next 10 years, it looks like. What's your reaction to that budget?
Look, he's going to keep our country together by building back better. He's going to fix a whole set of lagging public investments in everything from making the airports work so it doesn't take half again as long to fly from Boston to Washington as it used to making the IRS be able to collect taxes, to having modern investments in science and technology. That's all right, and that's crucial. So is doing much more for children. So is doing much more for people who've been left behind. I'm all with that, and I think it's hugely important. But just because you care doesn't mean you don't also have to count. And I think we are, as a country, going to have to look at the total amount of spending we're calling forward and the total amount of taxing we're calling forward. And I am worried in both the short and the medium term about overheating. It might be that the forces of what I used to call secular stagnation, basically people not wanting to spend, are going to be so strong that we need these kinds of massive budget deficits and extraordinarily low interest rates to propel the economy forward, and this will work out fine. That could be the case. But I think the greater chance is that we're going to have some kind of collision between demand and supply. David, you know, if you look at the administration's economic forecast, they've done what all administrations do, and it's entirely legitimate. They, several months ago, froze a set of budget assumptions to reflect in an entirely honest and accurate way what the consensus was then. But gosh, the consensus sure has changed. I don't think the idea of a 1.2% 10-year rate for this year looks particularly good right now. We've already had just about 2% inflation just in the months we've had of this year. So I think the year inflation figure is going to come in pretty high. And I think that the magnitude of those surprises just speaks to the fact that we're going to have to make some adjustments that go beyond what I think is the Washington three-part cycle on inflation. First, you deny that it's a problem. Then you say that it's just due to specific factors and specific transitory factors. And then you say, well, it's not really that big a problem after all because wages are going to go up along with prices and it's all going to sort of be okay. And I guess I see us moving through that cycle a bit, and that worries me. And it worries me because I think it's so important to do the fundamental things that the president is trying to do, but you do have to manage the macroeconomics right as well.
Larry, one of the things you mentioned was the possibility of taking some of the money that's been appropriated for the state and local governments that may not need and reusing it in other ways. It appears that the Senate Minority Leader, Mitch McConnell, agrees with you on that. He quoted you on that and said, boy, Larry Summers has got it right. So you're in raging agreement, it appears, with a Republican here.
Well, I wouldn't have necessarily expected to be on the same side as Mitch McConnell, but I think on that question, he does have the right view, and I think I have a view that we would do well to follow. But the minority leader is selective when he quotes me because he doesn't tend to pick up on my view that the Trump tax cuts are looking increasingly grotesque in the current environment of massive stock market, zero cost of capital, all of that, and the kinds of steps that President Biden wants to take to restore some normality to corporate taxation and to, at long last, do what we all ought to be able to agree on, crack down on the erosion of profits because they're moved to the Cayman Islands and places like that through international cooperation. I have to say I'm disappointed that that can't be an area of bipartisan American cooperation. I would have thought that that was the kind of thing that Republicans would stand for on strengthening America grounds, encouraging investment in America. So I think the minority leader is way too selective.
Larry, we do a Summers Inflation Watch on this program every week. You've already mentioned some of the issues about inflation, but we also got some data out. We didn't just get the budget on Friday. We also got some data, particularly core PCE. What did you see in those numbers?
Look, more of what I saw in core CPI. On a month-to-month basis, the inflation rate was running at an 8% annual rate. Now, that's, of course, totally distorted by transitory factors, as Secretary Yellen and Chairman Powell point out, but you can have a lot of transitory factor in an 8% number, and it's still saying something quite ominous.
Finally, Larry, let's sneak in a couple of short Summers Says here at the end. There's a big event in the corporate world this week when ExxonMobil, the management, lost a vote, actually getting activist shareholders to put at least two members on the board to really make it more of a climate-friendly company. Is this the beginning of something to come in terms of shareholder activism, particularly in ESG?
I think it marks something. You can like ESG investment, you can not like ESG investment, but it is here to stay as a major phenomenon that's going to be really important in many capital market aspects. And I just hope the steps that are taken are substantive rather than just optical. And I think we have to think very carefully. You know, if we're going to have a charge away from fossil fuels and we're going to move to renewables, which is the right thing to do, should Exxon play a larger role? Or is Exxon good at fossil fuels and they may not be the best at solar power and they're better off paying out their cash flows and letting the markets allocate those cash flows to the best places? I think there's some hard questions that we have to think about, but for sure, ESG is a big deal for a long time to come.
Last one, Larry. The real yield has been in negative territory, well in negative territory. It's come up a little bit, but it's still negative. When do you think we'll see a positive real yield?
Between a Fed that's complacent about inflation, rising inflation tendency, and crucially, a whole set of structural factors, demography, cheap information, technology, demassification of the economy. I think it's going to be a long time till we see a 10-year tip that has a positive real yield. Not in the next 3 or 4 years would be my guess.
Thank you so much to our special contributor, Larry Summers of Harvard. Finally, one more thought. It ain't easy being a CEO these days. Much of Wall Street watched this week as the princes of the realm, and finally, one princess in the form of Jane Fraser, testified to Congress about all the things they're doing to help people recover from the pandemic. Although Senator Elizabeth Warren was having none of it when it came to Jamie Dimon's JP Morgan charging for overdrafts.
Without that overdraft money, would your bank have been in financial trouble?
We waived the fees for customers upon request if they were under stress because of COVID.
You know, I appreciate that you want to duck this question.
One of the issues that got the most attention was what the banks were doing about climate change. But when it comes to climate, the real smackdown this week was at ExxonMobil's annual shareholders meeting, where an upstart activist shareholder group holding only a minuscule portion of Exxon shares took on management. And to everyone's surprise, forced at least 2 of its candidates onto the Exxon board, directors who will advocate for remaking the company to address climate issues. And just in case any CEOs didn't get the message, the same day, Chevron shareholders overruled its management to require the company to cut pollution from its customers.
Across our society and among all stakeholders, interest in these issues has never been higher. And I think the vote reflects that.
And a Dutch court told Shell it had to move faster to cut emissions. No, it isn't easy at the top. Sure, you get paid a small fortune, in some cases more than small, but you are reporting to an ever-expanding group of people with a say in your business. Now, it's not just the shareholders and the employees and customers and Wall Street. Now it includes social movements and perhaps, just perhaps, the weight of history itself. That does it for this episode of Wall Street Week. I'm David Weston. This is Bloomberg. See you next week.